On 6th of April 2017, Kat purchased a residential freehold property which she let out. However, Kat is unsure whether to purchase the property personally or via a limited company. The limited company would be incorporated for sole purpose of purchasing and letting out the property, and Kat would hold all shares in the company.
Okay, what needs to be considered? What needs to be thought about? So what we have here is 6th April 2017. So it's the start of the tax year.
Yeah.
Residential freehold property. So something like that is telling me capital gains is 28%, 18% or 28%.
Yeah.
So I'm just talking about general things that should be running through your mind when you see this information. And this is very beneficial for your exam. Also, in the exam, I'd advise you to read the question twice at least, because the second time you read it, you'll always find something new. 3 times would be even better. And yeah, as I say, some of these things may not even be relevant to your answer or to the question, but these are things that should be thought about generally. She will let out, so we have some sort of rented income, and purchase the property personally or limited company. So then I'm thinking the whole personally would be self-employed, class 2, class 4 self-assessment. Limited would be dividends potentially and corporation tax. The limited company would be incorporated for the sole purpose of purchasing and letting out the property, and Kat would hold all shares, so 100% shareholding, and it's an investment company. It's not a trading company, it's an investment company.
Yeah.
Continue, please.
Regardless of whether the property is purchased personally or via a company, the property will be let throughout the year ended 5th of April 2018 at a monthly rent of 2,600. The purchase of the property will be partially financed with a repayment mortgage. Mortgage interest of £12,000 will be paid during the year ended 5th of April 2018. The other expenditure on the property for the year ended 5th of April 2018 will amount to 4,600. This is all allowable. Kat will also have employment income of 60,000 for the year.
Okay, so what are your thoughts?
So there's 2,600 times 12 for income.
Agreed. Property income, good.
Yeah, property income. The mortgage interest, is this the 100% thing that's new?
Correct. Yeah.
Yes. So I can deduct all of it, or there was a calculation I had to do?
Well, you can't deduct anything now. 100% is not deductible, but that would be personally.
Okay.
And then you get the tax.
Sorry, yeah. So in a company, you can reduce all 12,000.
Agreed. So that'll be the difference in your computation. Personally, you won't get any deduction for the 12,000, but you'll get a tax reducer of 20%.
Okay. Yeah.
Okay. Yeah. But in your company's calculation, it'll be an allowable expense of £12,000.
Okay. The 4,600 is deductible for both.
Both. Agreed.
And then the employment income is just employment income that you just have in the computation. So it will either be 60,000 employment income and property income, whatever we calculate, or it will be trading profit, right? If it's a limited company.
No, it won't be trading profit because that's self-employment. It would be either salary or dividends. Or both.
Okay.
Because he'll be an employee of the company, and he'll receive a salary from the company, which will effectively be employment income as well, but from her own company, and she may get dividends as well, so it'll be dividend income.
Okay.
So are you understanding the fundamentals behind it?
Yeah.
the difference between personal and a limited company. These are the sort of differences effectively we're talking about. And the company would also have corporation tax at 19%.
Yeah.
Let's continue, please.
If the property is purchased via a limited company, then the company's corporation tax liability at the end of 2018, 5th of April 2018, will be 2,774, and CAT will withdraw dividends from the company totaling 6,000 during the tax year 1718. There's no other income for tax year 1718.
Now they've told us
Hmm.
what exactly she will withdraw from the company. So it'll only be dividends.
Yeah.
We'll only have dividends. We'll have employment income 60,000.
Yeah.
And we'll have dividends 6,000.
6,000.
And the corporation tax liability will be 2,774. All make sense? Any questions?
No.
Now, obviously, in the exam, as I say, you'd read the whole question again. But due to time constraints, we'll just sort of move on. But feel free to read it again when you do answer the question.
Yeah.
So what we need to do is determine whether there will be an overall saving of tax for 5th April 18 if CAT purchases the property via a limited company rather than purchasing it personally. So they've told us you should include a calculation of income tax liability if she purchases personally and via a limited company, and ignore NIC. So effectively, you're doing two computations.
Yeah.
You'll have one for personally. So when we have personally, effectively, we'll have employment income and property income, less your personal allowance, and then you have 20, 40, 45%. And then you just need to keep in mind the mortgage interest restriction personally. And if you say company, then we'll
employment
simply
and dividend.
Exactly, employment dividends, and then some of it will be at 7.5%, 32.5%.
Okay.
So let me leave that for you.
Yeah.
Explain one way in which the calculation of a future taxable gain on a property disposal made by the limited company would differ from the calculation of a taxable gain on a disposal made personally by a CAT. So let's just talk this answer through, please. One way in which the calculation of a taxable gain on the property disposal, so as I mentioned, 18.28%, made by the limited company would differ made personally, on a disposal made personally. What are your thoughts, please?
So if she did it through the company, then she has to pay capital gains tax.
At what percent?
At 18.28.
No, that's personally. If she disposes personally, that's capital gains tax, and through the company is just corporation tax, chargeable gain, as I said.
Okay, yeah.
So you have to remember that.
Okay.
Through a company is a chargeable gain.
Yeah.
And individually is capital gains tax. So yes, you'd get a mark for saying that. You'd say if she disposes personally, it'll be 18.28%. Most likely, what percent would it be based on the information provided? Employment income is 60,000.
She's a higher rate.
Exactly, she's higher rate.
Yeah.
Therefore, there'll be no basic rate band available, so it'd definitely be 28%.
28. Yeah.
But in the company, it'll be fixed at 19% regardless.
Yeah.
Okay.
Okay.
Any other differences that you can think about? Making a disposal personally against making a disposal through a company? The other point would be if she disposes personally, then she'll get the annual exemption.
Okay.
But the company does not get annual exemption. The company would get indexation allowance.
Okay.
Do you remember?
Yeah, I remember.
Exemption, indexation.
Yeah.
So that's the key difference. Companies do not get annual exemption, and individuals do not get indexation allowance.
Okay. And the annual exemption is 12,000. or 12,300.
I think it's 12,300. Yes.
Okay.
Correct.
And then the
Correct.
indexation is just what they gave in the question up to December 17.
Exactly. So here they're not asking you to calculate, but
Yeah.
that would be a explanation of one difference in the calculation for one
Okay.
mark. So that's a generous mark, quite straightforward. Let me leave you with the 9 marks. Prepare a computation. I'll check back up on you in 11 minutes.
Okay.
11 minutes. Computation for both, and then we'll discuss your answer.
Okay, thanks. I have a feeling my limited company calculation is wrong.
Okay, no worries.
Yeah, let's see.
When we're saying limited company, we still mean how she will be taxed personally, if that makes sense.
Yeah, I wasn't sure if I left anything up because they've mentioned here corporation tax. They've mentioned here the mortgage interest.
Yeah. Okay. I see what you're
Do
saying.
I mean?
Yeah. As in the sense you're not sure do you have to deduct it or not because they've already given the liability, so that's fine. Don't worry. We'll have a look at it.
Okay.
Okay. So let's start personally.
Yeah.
So working one. Where's working one? 31,200. Where did we get 31,200 from, please?
The 2,600 rental income.
Allowable deductions 26,600 less personal allowance. Taxable income 37,500. 36,600 at 40, and then let me just see the working for the tax reducer, please. Yeah, excellent. 20% of 1,200 gives you. You shouldn't call it taxable total profits. That's for companies.
Okay.
Taxable income. Sorry, not taxable income. Tax liability.
Tax liability. Okay.
Yeah. Good. Yeah. So now for the company, I'm happy. 6,000 personal allowance comes off the non-savings income in priority. Why?
Because it's 20% tax as opposed to 7.5. So it's
good. So we have 37,500, 10,000 at 40%. You've forgotten the 2,000 at 0% dividend.
Yeah. Oh yeah.
So as I say, it's good to make these mistakes now, but as long as you're picking up on them next time and the same mistakes not happening, then it's fine.
Yeah.
So remember the 2,000 dividend nil rate band or something like that.
Yeah, I was so worried about the like missing these things that I wasn't even concentrating here.
Yep, no worries. So then that would be 4 now. Yep. Yeah, and why would it be 32.5?
Because it's higher rate now, the income.
Correct. Yeah. So 12,800, that's the tax liability. Now, what he's trying to say is you need to, as per the question it mentioned, if you just go up slightly, determine if there will be an overall saving for the tax year ended 5th April 2018 if purchased through a limited company. Okay, so here we do a comparative calculation. Somewhere here, I'll just do it here. Is that okay?
Yeah.
So we say purchased personally, tax liability is 19,740. Purchased limited company. This is where the 2,774 they mentioned comes in. So effectively, you'll do 12,800 plus the corporation tax liability, which was 2,774, I think.
Okay.
2,774. So then I'll just do that here. So as you can see, the tax saving is 4166.
Okay.
Because you have to remember that she still needs to pay corporation tax, even though it's the company's liability.
Yeah.
Still, it's still an expense when it comes to, or when we're looking at tax savings, you still need to include it.
Okay.
Because it's still a tax that needs to be paid. So the overall tax saving would be 4166. So what would the advice be here? The advice would be that
Purchase
yes,
through limited
she should.
company.
Exactly. But then the additional advice would be purchase through limited company. Why? Because there's a tax saving of 4,100. But the additional advice would be that working or incorporating a limited company means more administrative burdens, increased compliance costs such as accountancy fees and PAYE, corporation tax return fees and software fees, and also more legal requirements. So more administrative duties and more legal duties as well. So that all goes with the tax saving of 4,166.
Okay.
Effectively, what I'm trying to say is it'll eat up into some of your time and also compliance fees such as accountancy fees. So that tax saving will be eroded. But I personally would say you'll still end up with a potential tax saving of 3,000. Let's just say everything else is 1,000. There's still a tax savings, so you'd go for the limited company.
Yeah.
Any questions?
No, that's fine.